So here is a review from chapter 1 of the tax formula. Basically, it's the tax form kind of compressed into one list of numbers. So the first number up here would be the total of all the taxable types of income. Then we would subtract out deductions classified as 4 AGI, adjusted gross income, to arrive at a number called adjusted gross income, which is very important because this number is used to calculate amounts for other income up here or other deductions over here or here. Also, we're going to subtract out the most common one is standard deductions that you learned in chapter 1 based upon the taxpayer's filing status, possibly age or disability, and itemized deductions or itemized, yeah, not both, and qualified business income deductions is also subtracted to get the remainder of taxable income. And in chapter 1, we learned that taxable income is then looked up on the tax tables if the taxable income is less than 100,000, or if the taxable income is greater than or equal to 100,000, we would use the tax rate schedules to get the tax for the whole year, called the tax liability. Then we subtract out tax credits and also amounts you've already paid, like withholdings or estimated tax payments, to get to the bottom line. Either you have an overpayment that's refunded or maybe credited to next year's prepayments, or a balance due, a tax due that you have to come up with when you file the tax return. Now, all of these amounts are, again, grouped together on the actual 1040 form. So let's take a look at that 1040 form. This is for 2018, and the 2019 return has a little bit more detail. Still not two full sides of one paper yet, but it's probably easier to work with than this 2018 form. Note that the first thing you fill in here at the top is the taxpayer's filing status. The filing status is important because it helps you figure out back here the taxpayer's maybe standard deduction. Also, the tax rates that are built into the tax table or listed on the tax rate schedule are based upon the filing status of the taxpayer. So that's important to determine one of these 5 filing statuses for a taxpayer. Then you have the taxpayer's name, social security number, and if it's a joint return, for the spouse. In the case of the standard deduction, there may be some additional adjustments to the regular amount if the taxpayer can be claimed as a dependent, or if the taxpayer has age 65 or older, or if the taxpayer is disabled or blind. Here's the address you would use for corresponding with the IRS. And if you don't have your refund direct deposited into your bank account, this is the address the refund check will be mailed to. Something different that you won't see on the 2019 return that you do see here on 2018 is this question regarding whether the taxpayer and the other people listed on the return are covered with health insurance coverage for the whole year. If you weren't able to check off this box here in 2018, you may have been subject to something called the shared responsibility payment. That's just a penalty if you're not covered with health insurance. That penalty disappears. This question disappears for 2019 and forward. If you have dependents, you have to identify them here and then check off whether they qualify you for that $2,000 child tax credit. Otherwise, they may help you with a $500 other dependent credit. The taxpayer would sign off and date. Make sure you fill in the taxpayer's occupation. That kind of helps you identify maybe the types of income or deductions that may have to be claimed on a return. If a taxpayer has problems with ID theft, they should be receiving every year an ID PIN number mailed to them, mailed to their their address, their home address. And that number changes every year, yeah? So if you don't put in that number, the IRS will have a harder time processing the return. Okay, so most times returns are now filed electronically, but if you do have taxpayers still mailing in the return, they gotta sign and mail it to the correct address as listed in the instructions to the 1040 form. Professional preparers have to fill in this bottom section down here. You don't need to fill this in. For example, if you prepare a return for family members or friends without being paid, yeah, you would just leave all of this blank here. Let's take a look at the back side. So again, we learned some basic income that's reported here. And if it's not listed on this lines 1 through 5, then it may have to be reported on a Schedule 1. And we're going to see the Schedule 1 for our business income. And listed here and added into the total. You also have deductions, possibly subtracted, that are listed on that Schedule 1 to arrive at adjusted gross income. Here's where we subtract out the standard deduction or itemized deduction, just like we saw in that tax formula, and QBI, or sometimes they call this Section 199A, Cap A deduction. To arrive at taxable income, that you look up on the tax table or use the tax rate schedule to get the regular income tax. And here we subtract out those credits. The self-employment tax we'll see. Probably it is listed under this other taxes. To get the total tax for the year, and we subtract out the taxes already paid through withholding. We're also going to see possibly taxes we've paid through estimated quarterly tax payments that's reported on this schedule here, at least for 2018. To either get an overpayment that we want to probably have refunded to us, maybe faster by filling in this direct deposit information. Otherwise, again, the refund will be mailed to that address we have on the front of the 1040 form. Or if we have a balance due, you can also pay that electronically by setting up an account with the IRS online or mailing in a check with this paper form. And the amount would be over here, the amount you have due. Let's talk about itemized deductions. So if you do have itemized deductions, you know you have to, here's the 2019 form. It's not too much changes, but probably better. It's listing out more amounts right here on the 1040 form versus having going to some schedules, yeah? So here's the back side of the 1040 form. And it ain't no postcard size anymore. I wish they would even put more lines here on this 1040 form. Would make it easier, and then we would have to have less attached forms and schedules to the 1040. But let's talk about itemized deductions that are reported on a Schedule A. More and more people are claiming standard deduction in the current years because the standard deductions have basically doubled in amount from 2018. So itemized deductions, at least on the federal, are being used less. I've read somewhere roughly 90% of taxpayers filing returns are using standard deductions. The thing is, Hawaii, at least some states, have not changed their rules for itemized deductions. So you may claim the standard on the federal, but because the standard deduction is so small on the state, especially Hawaii, you're probably going to itemize on the Hawaii return. So you still may need to prepare this federal Schedule A to help you calculate the itemized deductions on the Hawaii return. Let's kind of zoom in here on our Schedule A. So you can see the different categories off to this left-hand side of the schedule. So the first category was medical. And for most people, they don't report anything over here. So in line 1, you would have to report the qualifying medical costs for the year after health insurance has paid their share. And then what you gotta do is reduce that amount in line 1 by 7.5% of your adjusted gross income that you report back on the 1040 form. This 7.5% is increasing to 10% for 2019 and future years. So because this reduction here is so big compared to this amount after insurance now, line 4 is probably 0. Okay? 0. Not used that often unless you have some kind of major surgery. Next section is state taxes that you can deduct. And of course, the big one would be income taxes that you've paid, including what was withheld from your pay during the year. And also real estate taxes you pay. But for 2018 and subsequent years, there's a dollar limit of now 10,000. So for many moderate taxpayers and wealthy taxpayers, they're going to hit this $10,000 limit very easily. So no matter how big of amounts you have listed here, what you'll see here in line 7 is a maximum of 10,000. In the next section, for interest, basically mortgage interest, there was limits based upon the loan amount. In past years, it was, I believe, 1 million or 1.1, roughly 1.1 million of loan interest on that loan amount. Again, this is not the interest, but the loan amount. And what you're deducting is the interest on that loan. For 2019, that limit went down to new loans now. Yeah? Old loans are grandfathered in at the 1.1 million. New loans are limited in deductibility of a balance of 750,000. So for people who have big mortgages, possibly there's going to be less being deducted over here based upon this loan limit, at least for 2018 and future years. The next category would be charitable contributions, and it's divided up into two parts, either money being contributed or non-monetary contributions. So you got to make sure you have receipts, they call it acknowledgments, and some documentation, especially if you're contributing non-monetary charitable contributions. Casualty and theft losses have been very limited. Right now, they're only deductible by individuals if it's for a federally declared disaster. So for here in Hawaii, we're looking at stuff like hurricane losses or tsunami or even lava flow damages. And you will have to fill out this form here. Otherwise, smaller stuff like car accidents, even though it could be thousands of dollars losses, you cannot claim that anymore because it's not a federally declared disaster. So at the very bottom, we would total up our itemized deductions. And again, you would only use this Schedule A for federal purposes if it's larger than your standard deduction. So here's a sample of the tax tables, and you use again the tax tables if your taxable income is under 100,000. It's built for only taxpayers with less than that amount. So you would go across the taxable income row, and then you stop under the filing status column. Yeah, your filing status. Note that, let's kind of zoom in here. If let's say that your taxable income is 69,750, you notice it also appears here. What you got to do is use this second row, yeah, not this first one up here. And then again, you stop under the filing status column to get your total tax liability for the year. Let's take a look at the tax rate schedule or in the instructions to the 1040 form. So you would first find of course, again, your taxable income has to be 100,000 or more, and you find the correct tax rate schedule. So we have it based upon the filing status. So here's an example for Carol, who has a single filing status and her taxable income is more than 100,000. So the formula is to take that taxable income and you look it up here in this rate schedule, and it falls within this range right here. over 82,500 but less than 150,000, 57,500. So what we got to do is subtract out this beginning amount, which is repeated over here, yeah, from the taxable income. And then the excess of our taxable income over that beginning of what we call these brackets, beginning of this fourth bracket, the excess is taxed at this rate. Sometimes we call this the marginal tax rate. So just the excess is taxed at that marginal rate. But then the first $9,525 is taxed at 10%. And then the second range is taxed at 12%. And the third range is taxed at 22%. So instead of doing all this multiplication and adding, all of these amounts are built into this amount right here in this same line we're working with, $14,089.50, which is the tax on the first three brackets. And here's the tax on her marginal rate, marginal bracket. And we add all of it up to get the total tax liability for the year. Okay, so that's how, again, you use the tax rate schedule. Let's talk about another tax rate for qualified dividends. Again, a topic that you had learned last semester. And then also capital gains, really net capital gains or net long-term capital gains that get taxed at lower tax rates than we have built into the tax table or the tax rate schedule. Here are those lower rates, 0, 15, or 20%. And based upon the taxpayer's filing status, you would look up their taxable income that includes that qualified dividend and capital gain income, either from 0 through 38,600 for a single person. What you would do is you would back out that qualified dividend and net long-term capital gain and tax it at 0. And then the rest of the taxable income, you would use the tax table to figure out the tax liability for the whole year. But the most common rate is for people to fall within 38,600, and you notice here how high this amount is. So most people don't reach this. So if their taxable income falls within these two numbers here, you would back out the taxable income, back out the taxable gain and qualified dividends, and tax those amounts at 15%, which is going to be lower than the marginal rate they fall in. And then the rest of their taxable income, you would use a tax table or tax rate schedule. Again, that's based upon these bracket amounts here are based upon the filing status. And you can see it's adjusted for inflation for next year. Okay, so again, if you have this type of income, qualified dividend, and net long-term capital gain, there's an additional calculation you got to go through to figure out the tax. And it's not really on a tax form that you do this calculation, but it's done on a worksheet that comes from the instruction booklet for the 1040 form. And usually worksheets are not filed with the government. You just keep it for your own records. So if you go through this detail, you'll find out you have to do something called a Schedule D and Forms 8949. But eventually all the nitty-gritty calculations are done here. So if you remember that 0, 15, and 20% rates, well, here's those bracket amounts again, yeah, that we saw in the previous slide. And here's the 0 rate. And here's the 15% rate. And here's the 20% rate. And they tell you to, go use the tax table or the rate schedule to figure out the tax on the other income to get the total income tax liability. Now, there's other taxes besides income taxes, especially if you have this qualified dividend and long-term capital gain. Yeah, there's something called net investment income tax that for wealthier, higher income taxpayers, they have to pay another 3.8% on their investment income. So here's some example of credits. So if you have children, I believe under 13 or 14, under 13, and you have to have care for them so you can go to work, we have the child independent care credit. Even elderly, maybe parents or a spouse that can't take care of themselves, that you have to have pay care so you can go to work or even go to school. You may get a credit for that type of expenses. Maybe this applies to you, the education credit. Okay, and we may see this again later on this semester. And then the government motivates taxpayers to save for their retirement by giving them a credit here. Another credit is for people who have work income. They call it earned income. Yeah, job income, business income. And generally, if you have children, this type of credit for moderate low income taxpayers can end up in the thousands of dollars.